stock market in Tanzania saw a mixed bag of performance in 2022. Domestic stocks closed up on a good note, while cross-listed stocks registered a decline in performance. Ammi Julian, investment and research analyst at Orbit Securities, spoke to CNBC Africa's Julius Bizimungu.
Growth have been driven by the banking stocks. You know, the likes of NMB, which has been up by 75%, the likes of CRDB, which has been up by 57% year to date. And we have the self-listed Dar es Salaam Stock Exchange, which is up by 34% year to date, and Twiga Cement. So a lot of these companies, I can say the ones coming from the banking stocks, from the banking sector, and the ones coming from the investment sector have been the major drivers of growth in the market. Plus a few manufacturing stocks like Twiga, as I've mentioned earlier, which has been up by 15%. So much of the growth is divided, but highly denominated by the banking stocks, where we see also it's the market-specific indices. We see the banking indices, which comprises of finance, banking, and investment, is up by 41%. So growth is coming from that particular sector: finance, banking, and investment.
When you look at the banking stocks that you've just mentioned, that is a growth that you would say is really unprecedented given the economic environment where we are. What fundamentals are really driving the growth we've seen within these banking stocks?
Yeah, so for the particular banking stocks, the likes of CRDB, the likes of NMB, first we are seeing they have good PE ratios, which are way below the industry standard. Yeah, you know, you have NMB where it's trading at a price earnings ratio of around 4%, CRDB around 3%, where the industry average is around 10%. So they are highly undervalued in terms of when you look at ratio analysis. But also when you look at for those investors, for instance, speculators who are looking at short-term trading, when you look at price changes, you see, like as I mentioned earlier, double digits increase in price gain year on year. As I said earlier, NMB is up 75%, CRDB is up 57%, but also fundamentally, we see these companies are quite efficient in terms of cost to income ratios, where the recommended cost to income ratio by the Bank of Tanzania, which is the regulator of the banking sector, is 55%. But you see NMB, CRDB, they are all their cost to income ratios way below that particular prescribed ratio or prescribed cutoff by the government of Tanzania. We see NMB, CRDB, they're around 49 to 42%. They're ranging between 42 to 49% cost to income ratio. So while they're creating income, but also they're doing their best to maintain their costs.
And then how about the manufacturing stocks? Because when you look at Twiga Cement, for instance, that was an improved performance, you would say. Does that signal the recovery within the manufacturing sector? Because earlier in the year, we saw manufacturing really sort of struggling, given what was happening, you know, across the world with global supply chain issues. Does the performance we saw last year within the manufacturing stocks really signal or reflect the recovery within the manufacturing sector?
Yeah, the performance from the manufacturing sector, to some extent, I can say reflects the recovery. But you know, we just started to recover in 2022, and then the Russia-Ukraine turmoil just happened. But also, fuel oil prices just surged, you know, last year. That being said, it brought a shock. It brought an unprecedented shock to the particular manufacturing stocks or manufacturing listed companies, the likes of Twiga, the likes of Tanga Cement, where we see that they had to incur some costs, especially driven by fuel prices. But also later on in Tanzania, we had issues with energy, the supply of energy. That actually affected, because these particular companies now, they highly relied on electricity, but now they had to shift towards using normal fuel, and with fuel prices being up, their costs were highly magnified. So they had a rough second half of 2022, but looking at their Q4 results, that is reflected, but we see investors have actually been quite receptive of whatever shock happened, and that is reflected in the stock price positively. Fortunately, investors have been quite optimistic of these particular counters, so they are quite positive, and we see TPCC have had a surge from 3,000 to 3,700 Tanzanian shilling per share to 3,900 Tanzanian shilling per share in a space of 4 weeks. So the sentiment is quite positive, though these particular manufacturing stocks have had quite a rough second half of 2022 in terms of their operational costs.
And then, I mean, when you look at, on the other hand, when you look at the Offshore index, we saw it closing in the negative territory last year with weak performance, especially for cross-listed stocks. You're talking about a decline of 0.82%, mainly to Kenyan cross-listed stocks. What message does that send to the market? A buy and hold strategy?
Yeah, in terms of the Offshore index, the message it sends is it's first of all, we can say that the Tanzanian listed companies, they are small in size compared to the Kenyan ones. So whatever is happening to the Kenyan market has a huge effect to the index here in the Offshore indexes in the Dar es Salaam Stock Exchange. That being said, I can say that investors, when they look at Tanzania, they should also try to look at the other index, the Tanzanian share index, which has also been up by 9%, because sometimes if we just have a one specific look at the Offshore index, you might not get the true picture of really what's happening here, because a lot of it is also influenced by what is happening with the cross-listed shares, as you have mentioned. So for investors, one should quite take a look or focus on the Tanzanian share index, because it will give you or provide you a clearer picture of what is actually happening in the market.